You need to watch this if you struggle with understanding your mortgage payments. Welcome to our video on mortgage amortization. Today, we'll explore what mortgage amortization is and why it's important for homeowners. We'll also discuss the purpose of an amortization schedule and how it helps you understand your mortgage payments over time. By the end of this video, you'll have a clear understanding of how mortgage amortization works and how it can benefit you. So, let's dive in. Before we get into the details of mortgage amortization, it's important to understand some key terms. These terms form the foundation of your mortgage and will help you make informed decisions about your home loan.
First, there's the principal. The principal is the core amount of money that you borrow from the lender to purchase your home. It's essentially the price of the home minus any down payment you make. Understanding the principal is crucial because it directly affects the amount of interest you'll pay over the life of the loan. The principal is the amount of money you borrow to purchase your home. This amount is determined by the purchase price of the home and the down payment you make. The larger your down payment, the smaller your principal will be, which can save you money on interest in the long run. Next, we have the interest rate. The interest rate is the percentage of the loan amount that you pay to the lender as the cost of borrowing. This rate can be fixed or variable, and it significantly impacts your monthly mortgage payments. A lower interest rate means lower monthly payments and less paid in interest over the life of the loan. This is the percentage of the loan amount that you pay to the lender as the cost of borrowing. Interest rates can vary based on the type of loan, your credit score, and market conditions. It's important to shop around and compare rates from different lenders to ensure you're getting the best deal. Finally, the loan term is the length of time you have to repay the loan, typically expressed in years. Common loan terms are 15, 20, or 30 years. The loan term you choose will affect your monthly payments and the total amount of interest you pay over the life of the loan. Shorter terms usually mean higher monthly payments but less interest paid overall.
These factors, principal, interest rate, and loan term, greatly influence your mortgage payments. By understanding how each of these components works, you can better manage your mortgage and make informed financial decisions. It's also important to consider other costs, such as property taxes, homeowners insurance, and private mortgage insurance, PMI, if your down payment is less than 20%.
As you make payments, the interest portion decreases. This is because with each payment, a portion goes towards reducing the principal balance. As the principal decreases, the amount of interest you owe also decreases, which means more of your payment goes towards paying down the principal, while the principal portion increases. Over time, you'll notice that a larger portion of your payment is applied to the principal, which helps you build equity in your home faster. This process is known as amortization, and it's designed to ensure that your loan is paid off by the end of the term.
To illustrate this, we'll use visual aids. These aids will help you see how the interest and principal components of your mortgage payment change over time. Understanding this can help you plan your finances better and make informed decisions about refinancing or making extra payments to pay off your loan faster. To show how the interest and principal components of your mortgage payment change over time. By visualizing these changes, you can better understand the long-term impact of your mortgage and make strategic decisions to manage your debt effectively. Whether you're a first-time home buyer or looking to refinance, understanding these basics is key to financial success. The first step in understanding mortgage amortization is to gather essential information about your loan.
You'll need to know the loan amount, interest rate, loan term, and payment frequency. This information can usually be found in your loan documents or by contacting your lender.
If you're unsure how to calculate these values, don't worry. We'll walk you through a sample mortgage scenario as an example.
Let's say you have a loan amount of $200,000, an interest rate of 3%, a loan term of 30 years, and you make monthly payments.
With this information, you're ready to move on to the next step in understanding your mortgage amortization. Step 2. Calculate monthly payment. This is a crucial step in understanding your financial commitment when taking out a mortgage. Knowing your monthly payment helps you budget effectively and ensures you can comfortably afford your new home.
To calculate your monthly mortgage payment, you need to use a specific formula, M equals P times R times 1 plus R, to the power of n, all divided by 1 plus r to the power of n minus 1. This formula might seem intimidating at first, but once you break it down, it becomes much more manageable. Here, m is your monthly payment, p is the loan principal, r is the monthly interest rate, and n is the number of payments. Understanding these terms is essential. The loan principal p is the amount you borrowed. The monthly interest rate r is the annual interest rate divided by 12. The number of payments, n, is the total number of monthly payments over the life of the loan.
Let's break it down with an example. This will help you see how the formula works in a real-world scenario. Suppose you have a loan principal of $200,000, an annual interest rate of 5%, and a loan term of 30 years. These are common figures for many home buyers, making this example highly relevant.
First, convert the annual interest rate to a monthly rate by dividing by 12. This step is crucial because mortgage payments are typically made monthly, so we need the interest rate in a monthly format. So 5% divided by 12 gives you approximately 0.0417. This is your monthly interest rate, which will be used in the formula. Next, calculate the total number of monthly payments by multiplying the number of years by 12, which gives you 360. This represents the total number of payments you will make over the life of the loan.
Now plug these values into the formula. This is where the magic happens, and you can see how the numbers come together to form your monthly payment.
So your monthly payment would be 200,000 times 0.0417 times 1 plus 0.0417 to the power of 360 divided by 1 plus 0.0417 to the power of 360 minus 1. This calculation might seem complex, but it's just a matter of following the steps methodically.
If that sounds a bit complex, don't worry. Many people find this formula challenging, but there are tools available to help. There are plenty of online calculators and spreadsheet software like Excel that can do the heavy lifting for you. These tools are designed to make the process easier and more accurate.
Using these tools can save you time and ensure accuracy. They are user-friendly and often come with additional features that can help you understand your mortgage better, making the process a lot easier. By using these resources, you can focus on finding the right home and securing the best mortgage deal rather than getting bogged down in complex calculations. Online mortgage calculators are particularly useful because they allow you to input different loan amounts, interest rates, and loan terms to see how your monthly payment changes. This can help you compare different mortgage options and choose the one that best fits your financial situation. For example, you can see how a lower interest rate or a shorter loan term can reduce your monthly payment, or how a higher loan amount can increase it. This flexibility is invaluable when planning your finances. Additionally, consulting with a financial advisor can provide personalized insights and help you understand the long-term implications of your mortgage. They can offer advice tailored to your specific financial situation and goals. A financial advisor can also help you navigate the various mortgage products available, ensuring you choose the one that offers the best terms and conditions for your needs. By taking advantage of these resources and seeking professional advice, you can make informed decisions and feel confident in your mortgage choice. This will ultimately lead to a more secure and manageable financial future. Remember, understanding your monthly mortgage payment is just one part of the home buying process, but it's a critical one. With the right tools and knowledge, you can navigate this step with ease and move closer to owning your dream home. So take the time to calculate your monthly payment accurately, use the available resources, and don't hesitate to seek professional advice. This will ensure you make the best financial decisions for your future. With careful planning and the right approach, you can achieve your home ownership goals and enjoy the benefits of owning your own home. Good luck.
Step 3. Create the amortization schedule. This is a crucial step in understanding how your loan payments are structured over time.
An amortization schedule breaks down each monthly payment into its interest and principal components, providing a clear picture of how much of your payment goes towards reducing the loan balance and how much goes towards interest. It also shows the remaining balance after each payment, helping you track your progress in paying off the loan.
Let's walk through the process of filling out the first few rows of the schedule using our sample scenario. This will help you understand the mechanics behind the calculations.
For the first month, you take the loan principal and multiply it by the monthly interest rate to find the interest portion. This is the amount of your payment that goes towards interest. Subtract this interest portion from your total monthly payment to find the principal portion. The principal portion is the amount that actually reduces your loan balance. Then subtract the principal portion from the loan principal to get the remaining balance. This remaining balance is what you'll use to calculate the interest for the next month.
Repeat this process for each subsequent month. As you continue, you'll see how the balance decreases and how the interest and principal portions of each payment change.
You'll notice that over time the interest portion of each payment decreases while the principal portion increases. This is a key feature of amortizing loans. This happens because the interest is calculated on the remaining balance, which gets smaller with each payment. As the balance decreases, the interest portion of your payment also decreases.
To create a full amortization schedule, you can use spreadsheet software like Excel. Excel is particularly useful because it can handle complex calculations and automate much of the process.
Simply set up a table with columns for the month, total payment, interest, principal, and remaining balance. This structure will help you organize your data and make the calculations easier to follow. Label each column clearly so you can easily identify the different components of your payments. This will make it easier to track your progress and understand how your loan is being paid off. Fill in the formulas and let the software do the calculations for you. Excel can automatically update the remaining balance, interest, and principal portions for each month, saving you time and reducing the risk of errors. Once your schedule is complete, review it carefully to ensure all the calculations are correct. This will give you confidence that you understand your loan and are on track to pay it off as planned. Highlight key points in your schedule, such as the total interest paid over the life of the loan and the point at which the principal portion of your payment exceeds the interest portion. These insights can help you make informed financial decisions. It's also a good idea to double-check your calculations with a calculator to ensure accuracy. This extra step can help you catch any errors and give you peace of mind. Finally, save your amortization schedule and keep it in a safe place. You'll want to refer to it regularly to track your progress and make any necessary adjustments to your payment plan. Creating an amortization schedule may seem complex at first, but with the right tools and a clear understanding of the process, it becomes much more manageable. And the benefits of having a detailed plan for paying off your loan are well worth the effort. So take the time to create your amortization schedule and you'll be well on your way to financial clarity and success.
Step 4. Analyze the amortization schedule.
Once you have your completed amortization schedule, it's important to know how to read and interpret it.
Look at how the interest and principal components change over time.
One key insight is the impact of making extra payments. Even small additional payments can significantly reduce the total interest paid and shorten the loan term.
Also consider how changes in interest rates would affect your schedule.
Use the schedule for financial planning. It can help you make informed decisions about refinancing, prepayments, and overall financial strategy.
In conclusion, we've covered the key steps to calculate your monthly payment, create an amortization schedule, and analyze it.
For further learning, check out the additional resources and tools we've linked below.
If you found this video helpful, please subscribe, share, and leave a comment.
And don't forget to practice creating your own amortization schedule to get a better understanding.
Thanks for watching, and see you in the next tutorial.